Okay, I've got an important and interesting article for you from news.com.au, which is the News Corp outlet owned by Rupert Murdoch, which we know will sometimes give us news, sometimes not so much, or fake news. Now, the headline of this is very interesting, is home sellers drop listed prices by up to 30% in pockets of Sydney. Now, most people reading that would think that the Sydney property prices have dropped by 30%. That is not true. However, you'll see why I think that could end up being true. So the article goes on to say the homeowners in pockets of Sydney have been selling properties for up to 30% below their advertised price after a steep fall in buyer demand. Property experts claim sellers have been forced to accept GFC level price declines due to a weakening market, which makes it difficult to achieve the inflated sums properties were fetching 6 months or even a year ago. Sydney's median home price fell by 1.3% over the 3 months to December and by another 2.5% in the following 3 months to March, according to property research group CoreLogic. The latest 3 months decline was the largest since 2008 in August, near the height of the global financial crisis, and helped push the typical price of a home back down to $880,000. Cool, $880,743 to be exact. Further falls are expected. CoreLogic forecast the citywide median home price will drop a total 5% over 2018. The soft market means sellers are facing rising competition from other homeowners also vying for buyer interest. There are currently about 25% more homes for sale compared to a year ago, and only 80% as many people actively looking for property, industry figures reveal. This tells me that there's 20% less people actually looking at properties. Buyers have capitalized by dragging sellers to the negotiating table. The average house seller in the inner city suburb of Darlinghurst had to cut 30.6% off their advertised price to sell. Bellevue Hill sellers dropped their prices by an average of 16% before selling, while in Vaucluse the adjustment was 13%. Down south, sellers in nearby suburbs Sutherland and Alfred's Point slashed an average of more than 15% off their listed prices prior to selling. Other suburbs where sellers discounted their prices by more than 10% included Narrabeen, Camaray, Tempe, Coogee, Mascot, Belfield and Metroville. CoreLogic senior analyst Cameron Kusher said sellers were dropping asking prices because buyers were fatigued. No joke. Sydney prices have hit the point where they're unaffordable for a lot of buyers. The prices some sellers are setting initially are not what buyers are prepared to pay, Mr. Kusher said. Recent listings with high prices relative to the condition of the home included a terrace on Harris Street in Balmain listed with a guide of $1.65 million. The 3-bedroom home is uninhabitable with caved-in ceilings and other damage. Lovely. A Stanmore terrace in even worse condition is listed at $1 million. The walls are riddled with cracks and parts of the floor and roof have collapsed. It too requires hundreds of thousands of dollars to restore it to a livable standard. There are also a range of other homes currently advertised at considerable discount. A 4-bedroom duplex on West Street in Northern Beaches suburb Belgola is currently listed for $325,000 below its original price of $1.9 million. In Belfield, in the Canterbury area, a home at Statham Street is being offered at a $275,000 discount on the initial listed price of $1.45 million. A two-bedroom unit on Liverpool Street in Darlinghurst is advertised at $100,000 below the original listed price of $1.5 million. Realestate.com.au chief economist Nerida Consby said it was inevitable that sellers would reach a point where they could no longer command prices $100,000 or $200,000 above what comparable properties sold for months ago and still find a keen buyer. Sydney prices have been extreme for many years, she said. We've now hit the point where buyers can no longer continue to keep paying more. Does that tell us that the actual trend has turned? If the buyers cannot keep paying more, this is the time that it's either going to flatten or drop. So continuing the article, Corbin and Hayson agent Samantha Elvey also is selling the rundown home on Balmain Street. Said fewer prospective buyers were going through open homes in general terms. So largest 3-month median price falls by LGA are Mosman units minus 1.9, East Pollara houses minus 2.1%, West Camden units minus 1.7%, South Botany Bay units lost 3.6%, Inner West Ashfield houses have dropped by 6%. Well, ladies and gentlemen, I'm just going to scroll up to that up the top of that article to see that first image that says Cubden and Hayson agent Samantha Elvey at the rundown home on 44 Harris Street, Balmain, listed with a guide of $1.65 million. All right, so I'm just going to open this image for you in another tab. This, ladies and gentlemen, is a $1.65 million asking price in your lovely Sydney. Now, for those who are not following the news, there is currently a Royal Commission that is investigating lax lending practices of the big 4 banks in Australia. This Royal Commission, I am not sure what their powers are. However, it is damaging the reputation of the banks, and in my opinion, what is going to happen is that the banks are going to make it harder for people to borrow money, to get loans, personal loans, car loans, and mortgages for houses, which is going to dry up the liquidity, which in turn is going to make it harder for people to borrow to buy houses. So this is not looking good, but let's just have a look at a few video clips that will confirm this for you.
Some interesting warnings from the Reserve Bank today. This was Deputy Governor Guy Debelle suggesting investors should be wary of being too complacent about the current settings of interest rates and suggesting the market could react if we do see rates rise. What's your expectation, and do you think investors are being too complacent?
I think he's right on the money. We've been warning clients for a while about stocks that are heavily exposed to global bond yields. So infrastructure, real estate investment trusts, some of the telcos. These are the companies that, when bond yields do really start to move up, will be significant underperformers. But the one sector that I think the Reserve Bank is most concerned about in terms of complacency and risk is real estate.
I think you might be right on the money there, James.
All right, well, that is really what is going on right now. There is one more short clip I want to share with you. Again, there's a Royal Commission going on. They are grilling all the executives of the big 4 banks, which to show they are willing to change their ways, are going to have to change and make it stricter and change their lending practices. So people and who can fog up a mirror are not going to be able to get the loans. And this again is going to dry up the market, and the credit is going to be hard to get.
And late today, ANZ announced it will suspend granting loans for cars, boats and caravans while it undertakes a detailed review of its business. That comes as the bank faces a grilling in the witness box over those car loans in the Royal Commission on Banking Misconduct next week.
It was a day.
All right, well, that was it. That concludes this quick presentation. It's not looking good for those 4 banks, and like I said, they're going to have to do something about their lending practices, and it's not going to make it easier, but it's going to make it harder for people to borrow money, and that is obviously going to have a negative impact to assets that are normally acquired by credit, of which one is the most important and most expensive one, which is the Australian property.